Let's bring in Chris Verrone. He is partner and chief market strategist at Strategas. Welcome back. It's nice to see you.
Great to see you.
Still in flux. The words of the day. What does that mean for stocks?
Well, I think when you look at the market's response today, to us, it's reflective that a lot of bad news has likely been priced over the last number of weeks. I mean, we're down 10 from the highs. This is that retest of that, call it 5450, 5500 zone. Now, the retest is never fun, but we pointed out a couple interesting little facts kind of heading into the week. Note the VIX is below where it was really during the peak stress moment of mid-March. So is currency vol. So is bond vol. You actually had fewer stocks making new lows last week and this morning, despite the S&P trading back to that 5,500 level. Corrections are not fun, but remember, lows are put in on bad news, not on good news. And I think we've priced in, at least for now, a lot of bad news. I would suspect we rally out of this. 5,900, maybe 5,950 kind of being the top end of the range moving forward.
So you're approaching April 2nd, Wednesday, as a clearing event. It sounds like you're in the Tom Lee camp. Get this out of the way, and then we will have a nice rebound into April, though. Goldman's Tony Pasquarello with a note today, not really sold on that. Quote, the big dynamics in the game have changed, and it's not obvious to me that April 2nd will prove to be that clearing event. Preservation of capital is the name of the game right now. What he's implying for certain, yes, sure, you get more tariff news and you get it out of the way, but the game has changed. The goalposts have moved. What does that mean?
I think if the game has truly changed, and this is just not a 10% drawdown, but the start of something more pronounced, frankly, it's not going to be a question that we're going to be able to answer until later this spring or this summer as we watch this market rally. Does it rally with the expanding breadth we want to see? Do we see new highs re-expand? Do we see credit conditions start to behave here again? Those are the big questions I want to ask over the coming weeks. But in the near term, the undefeated rule of Wall Street reigns once again. As prices change, so do attitudes. I mean, look at any investor survey here. They've been turned upside down. There's more bears than bulls in most of them. Look at the consumer confidence numbers that we've gotten over the last several weeks. There's certainly a degree of pessimism out there that at least gets me interested in thinking about, hey, could this be the clearing event? What could actually go right from here? I think very little attention is being paid on that, Scott.
Oh, it's funny. When you were talking about the rule on Wall Street, I thought you were talking about the Fed put, because that's what everybody is thinking is going to come into play at some point. I got Tom Barkin sitting right to my left waiting for the interview that we're all going to do momentarily. We're obviously going to ask him about that. Is that part of the calculus, though, that at some point you either have a Fed put, a Trump put, or a both put?
Well, with all due respect to Mr. Barkin, we always say in our work we care more about the message of the two-year yield than any Fed speaker. And I think the two-year yield, breaking back down to this 380, 385 zone, I do think is reflective that the market's expectations from the Fed here are starting to shift. Now, Scott, when you think about this corrective phase, let's remember financials have held up pretty well during this. This is not your typical financials are worse than the index. It's messaging some big financial issue that's out there. Financials went into this correction as your leadership. They've held their own during it. I think they're likely to come out the other side carrying the flag. Compare that to tech here. Tech did not go into this corrective phase as your leadership, nor has it provided any help on the way down. I think very, very unlikely tech returns as the leader some people might expect on the other side.
Doesn't that lessen the possibility that the market can do okay? I mean, if we're having conversations day in, day out about uncertainty, slowdown versus recession, and tech's not going to lead the way, but the rest of the market is in the face of all of those questions?
Yeah, I mean, markets bottom on bad news. I'll never forget that first pullback after the 2009 low when you got bad prints and everyone thought recession was coming back. That was the low of that pullback. I use a similar kind of framework here. The headlines are about as bearish as we've seen in certainly a number of years. That doesn't mean you can't go lower from here, but in terms of the tactical call, I do suspect a lot of this has been priced here. Whether it's 55.05, which was last week's low, or this morning, or maybe 50 S&P points lower, I generally think we're in the ballpark or in the zip code of what will be a tradable low as we get into better seasonals into April and into May. If something more sinister is out there, I think we'll see it through credit, and I think we'll see it through financials not showing up on the other side. So far, there's not a lot of evidence of that just yet, Scott.